All right, Hewlett Packard Enterprise out this week with much better than expected quarterly earnings as corporations pick up their return to office spending. The computing giant also lifted its full-year profit outlook despite the uncertainties surrounding the chip shortage. Joining us now is HPE's CFO, Tarek Robbiati. Tarek, good to see you this morning. You're calling out really strength in really companies spending more to support their return to office life. How would you grade that strength right now?
Good morning, Brian. Thanks for having me. Great question. So we see very strong demand across the board, across all our lines of business, whether it's our Edge, Aruba business, our storage business, our high-performance compute, and server business. Demand is across the board. I think it's pretty strong in terms of lines of business, but also geographies. We see the demand to be sustained and a pretty long runway ahead of us. Partly, it has to do with the fact that companies have now learned the lesson post the COVID pandemic that they need to fundamentally change their business model. And digital transformation takes a different shape in the circumstance. It's not just about automating the basics of a business, but it's much more about fundamentally rethinking the business model in a way that makes it more resilient to withstand shocks like the ones we've seen during the pandemic. So demand is pretty strong, and we feel that that runway ahead of us is pretty long too.
Perhaps you can clear this up for us. I talked to some folks on the sell side that cover HP, and they called out some concerns about second half free cash flow. What investments are you making in the second half of this year?
Yeah, no, look, first of all, it's important to note that we posted record free cash flow in the first half. So we finished the first half with $931 million of free cash flow. Our original guidance for the full year that we gave in October 2020 for the full year 21 was 900 to $1 billion of free cash flow. We've upped the guidance twice now, and we are feeling very comfortable that we will post for the full year $1.2 to $1.5 billion of free cash flow. That's a $350 million increase relative to the guidance we gave 6 months ago. And what is happening between half on half is that we had a very strong first half where we emerged out of the pandemic with a much leaner cost structure. We also have made, in the latter part of the first half, substantial investments to buffer inventory. We do see the demand picking up strongly, like I said before. We buffered up inventory. Inventory went up by about $600 million for us. And that buffering of inventory is to cater for supply shortages that we see in some of the components that we need to manufacture our solutions. In saying that, we did see that shortage of supply coming. And we said that at the end of the first quarter earnings call. We said that we didn't have any issues short term. We were well equipped and we were solving for the second half of the year. We're still working through that, but the demand continues to rise, and this is something that we need to watch. I'm very comfortable about our outlook, and our outlook, whether it is looked at on an EPS basis or free cash flow basis, factors in any sort of uncertainty pertaining to supply.
I want to ask a little bit also about that ad as a service part of the business. You guys called out there, revenue growth, I think 30% in the quarter for that part. How are you thinking about how large a segment, how large a proportion, I guess I should say, of the overall top line comes from that part of the business, as again, that is growing faster than the overall company?
Yes, look, this is the epicenter of our strategy. 2 years ago, Antonio Neri, our CEO, and myself said, the world is going to be hybrid and we're going to move to a world that will not just be witnessing workloads solely taking place in the cloud. Yes, the cloud is there to stay, but it's an experience, it's not a destination. What most enterprises are realizing is that the cloud is actually very expensive, and there is all sorts of side effects, such as loss of sovereignty over the data, performance issues, and cost issues, like I said a second ago. And what they want is that experience of the cloud to be on their premises. And that's where we come in. We are enabling with our GreenLake as a service offering a cloud-like experience on premises of our enterprise customers. And it's going extremely well because at the end of the day, we're giving customers what they need. We give them the experience with control over the data. Data is going to be, for the next decade or so, the most precious asset that any company has, and they need to have that under their control. So our as-a-service offering has been doing extremely well. We've been growing consistently 30% quarter after quarter for the past 9 quarters now, and it's going to continue to do so. And we have put the guidance on our as-a-service business of a 30 to 40% compounded annual growth rate for the next 3 years. We keep shifting forward the 3-year window because this trend is very, very powerful, and we don't see that trend relenting anytime soon.
And Tarek, quickly before we let you go, you didn't pull any punches on the conference call, on the earnings call about valuations in the tech space. You called them exuberant. Does that prevent you from making a big acquisition this year?
Yeah, it's true. I did call the valuations in the tech space exuberant, but that applies to some subsectors of the tech space. I think software valuations are overinflated. They're very frothy right now. And overall, the market overvalues growth and undervalues cash. We generate a copious amount of cash, and we feel that right now there is that side of the equation is overlooked by investors who are really prepared to pay levels of premiums for growth that, in my mind, don't gel with my math. Anyway, it is what it is. We feel that there is a great need to be very disciplined in the way you conduct M&A acquisitions moving forward. We'll always have been. And we look at it from a pure fundamental view. We look at the acquisitions on a free cash flow multiple basis and the prospects of companies who are not yet mature to generate free cash flow pretty soon. And we will look at acquisitions very, very selectively. We have a very disciplined approach towards this. We did do a pretty interesting number of acquisitions in the recent past. Less than a year ago, we acquired a company called Silver Peak, which we merged in our Aruba Edge business. It's an SD-WAN provider, and it's proven to be a fabulous bet because Silver Peak is growing and very, very well within Aruba. Aruba, our Edge business, grew 17% year over year, and there is an incredible demand for our Aruba services and also Silver Peak within Aruba. So we will continue to look at acquisitions, but you got to be selective because valuations are frothy.
Well said. We'll leave it there. HPE CFO Tarek Robbiati, good to see you.
Welcome back to Yahoo Finance Live. I'm Julia LaRoche. Take a look at shares of J.M. Smucker and Company after the consumer packaged goods company reported fourth quarter earnings for the quarter ended in April. Shares are up more than 2% after those results. We're joined now by J.M. Smucker Company's CEO, Mark Smucker. Mark, great to have you back on. Shares are up here. It looks like analysts for that fiscal 2022 guidance, it came in above the consensus. That seems to be where we're seeing a bit of the optimism. So what are the macro themes that are kind of underpinning your outlook in the year ahead?
Yeah, thanks for having me, Julia. The first thing is I would just start with is what we have done over the last year to ensure that we come out of this pandemic a much stronger company. And those are things like becoming a leaner and more agile organization, building the correct, right, focused commercial capabilities around our customers, our retail customers and our consumers, and then just being very disciplined about prioritizing which growth initiatives and brands get the resources. So we've done that. And then, of course, our industry has benefited from the tailwinds of people working from home, of a significantly larger number of households with pets. And those tailwinds are continuing into our new fiscal year. People are going to continue working from home. We are not going back to the previous normal. There is a new normal that we are working through right now. And those tailwinds, as well as what we've done ourselves internally, are going to continue to benefit our business.
So you mentioned kind of the big one, the work from home. I was going to ask you what happens when folks start to, go back to school, for example, when the kids go back to school. How do you kind of think about maybe the impact to your business as it relates to the back to school movement?
Well, actually, we have one of our largest growth brands, our Smucker's Uncrustables peanut butter and jelly sandwiches. And that product actually began in its inception 20 years ago, began in schools. So obviously schools are a big customer of ours, but more broadly as adults, and particularly those of us who are in the workforce, are likely not going back to the same amount of time they spent in the office before. And so because folks are going to be working at least part of the time from home, and we are in categories, particularly in breakfast and lunch occasions, we view that those tailwinds are going to continue to help our business.
Yeah, I heard you say on the call that the Uncrustables did 130 million in net sales in the quarter, and that you all expect, I think, 500 million for fiscal 2023. So certainly some momentum there. I think a big theme we should talk about, Mark, is inflation. That's kind of been the story of late. And of course, you being a consumer packaged goods company with sourcing raw materials, what are you seeing out there as it relates to inflation, and how are you mitigating that risk?
Sure. So inflation is something that we deal with, of course, all the time. You know, because we're in the food business, most of our products are largely based on commodity prices, packaging, and so forth. We've seen this inflation coming. It really started back in April of 2020. And so as those things go, we have an obligation to address that. We're going to do that in a prudent fashion. We're going to do that working with our retail customers to make sure that we can pass along those cost increases, which ultimately will impact the consumer. But again, doing that in a measured and responsible way as much as we possibly can.
I know, yeah, you all had to do that with your peanut butter products, I think back in the fall, if I recall. I think you gave an investor presentation talk about it. Can we talk about what it might mean for the consumer? I would love to kind of explore that a bit further.
Well, sure. We actually are taking price action across broadly our entire portfolio. Most of those pricing actions will come into effect in July. Consumers will likely see them on shelf sometime in the early to mid-fall timeframe. But again, you know, we want to make sure that we're taking a responsible approach, working with our retail customers to ensure that we're passing on the right and fair increases down the chain.
Mm-hmm. And so earlier in this conversation, you were talking about kind of the brands, where you want to be. I know you all have been repositioning the portfolio over the last year plus, the latest divestiture, of course, of the shortenings and the oils. Before that, it was getting out of the baking mixes. Where do you want to be, and where do you see the opportunities for growth going forward?
Well, first of all, we love the three categories that we're in, essentially coffee, pet, and then more broadly snacking, going back to the Uncrustables comment. They're all great growing categories, and the brands in which we participate are, generally speaking, leading brands. So we will continue to lead in those categories. We will continue to reshape our portfolio and ensuring that the brands within the categories we participate are ones that can grow. So our decision to exit the baking category with the most recent Crisco divestiture, just understanding that that brand is not going to be a growth engine. Similarly, Natural Balance premium pet food, which we also divested this past year, also not going to be a growth driver. So ensuring that our portfolio is refined and consists of brands that we have confidence in the growth potential of those.
Mark Smucker is the CEO of J.M. Smucker Company. Mark, thank you again for your time, and look forward to having you back on in the near future.
Let's bring in our first guest for the hour. We've got Steve Sosnick, Interactive Brokers Chief Strategist. Steve, I know you've been following this one really closely. There seems to be two camps here. You know, on the one hand, you've got a company like AMC sort of acknowledging the wild swings they've seen in their stock, but addressing the retail traders through their program to try and keep the communication going. And then the others who say this is just simply too risky because the fundamentals do not bear out the price it's trading at right now. How do you see the action?
Well, Akiko, that's a tricky, complex question. I think at some level you have both. I mean, I wrote a piece yesterday, basically saying that it was clear that AMC was embracing the meme. and that it was thoroughly rational for them to do so, because here you have a company that has billions of dollars in indebtedness. They suffered a huge hit during COVID, which we all understand. But prior to COVID, they weren't making much money either. They had, they were more or less around flat line of earnings. They'd make money some quarters, give back money some others. They're same with their cash flows. It's not a company that investors really would cater to in terms of that steady sort of income and cash flow growth that you would expect or want. So what can you do to get out of the situation you're in with debt that's still trading, basically with interest rates of 8 to 12%? The bond market's telling you this is not a great company. And bond traders don't get caught up in hype the same way. They really only care about getting paid back, not about wild upside and volatility. And so I think that AMC said we're going to embrace this. Bed Bath & Beyond, he's got a different point of view. But like it or not, all the meme stocks are sort of wrapped up in this weird thematic trade, them and cryptos. And I think you see rotation. I wrote about this also. You see rotation between the cryptos and the memes. And it's just sort of this weird hot money sector linked together in a fairly tenuous way. I'd argue almost by nostalgia in terms of some of the meme names.
Yeah, either tied to nostalgia or tied to an intense want to gamble here in something that, as we're seeing, is extremely volatile. Volatility, to your point, only matched maybe by crypto. But when it comes to how maybe Bed Bath & Beyond is on the other side of the coin, as we were just discussing, not necessarily leaning into some of the enthusiasm there to kind of create maybe opportunities back to the business. I was kind of surprised. I pushed it a little bit here with Mark Tritton in our interview yesterday, just because you'd think that back to college crowd that they're trying to target might also be active on Robinhood. But I suppose you live by the sword, you die by the sword. So how would you weigh that when it comes to maybe running one of these companies undergoing extreme meme craze?
I think each management team is a bit different. It's a very idiosyncratic group of companies. I guess you have, predominance of consumer-oriented names in there because, again, I think they're linked by millennial nostalgia as much as anything else. My son basically summed it up in the first round where he said these are the type of names that if you found people are betting against them or that they're going to go out of business, it means that you're getting old and your childhood is over, which is kind of interesting. And so I think that really links them together. But that means there's no consistent management style. I think AMC and GameStop have embraced the meme full on. I think, some others like, Bed Bath & Beyond clearly have not. BlackBerry has been relatively quiet. Nokia, that's sort of meme resistant in some ways because it's too big of a European company to get fully caught up in this. But that's the problem is there's no real, other than that they are all memes together, there's really nothing that links them together. And so it's not like, what does Brian Moynihan do vis-a-vis Jamie Dimon? There's nothing logical about that.
I mean, Steve, you could argue that the meme never really went away. I mean, we talked so much about it back in January in the initial run-up with GameStop's stocks. We're talking about a 95% gain for AMC in one day. Today, it's down about 30%. What do you think is driving this latest wave? And then, I guess the follow-up here is that there are those who are invested in ETFs like a Russell 2000 that includes these names. Do you park your money there, or are you getting caught up in the risk as well?
Oh, there's a lot to unpack. I mean, I think you're absolutely correct in implying that the memes didn't die; they just went into hibernation, and that certainly is an element of it. In terms of its impact on the Russell 2000, although these companies have grown dramatically in terms of market cap, they're still quite small. Now we will start to hear tomorrow about the preliminary rebalancing of Russell, which is going to occur later this month, and that's going to be interesting to see how we take part in it. But otherwise, again, these are, I think, greed doesn't die, and I think it's not coincidental that we saw cryptos sort of fade off their highs and memes pick up the slack, because I think the money kind of follows from one to the next in terms of hot speculative trades. It's a weird amalgam to call a sector, but it trades like one.
Yeah, and maybe worth pointing out that we see Bitcoin now rising above 38,000 as we see AMC falling off more. When we talk about what this means, though, from a macro perspective, I mean, you can talk about maybe people who didn't even think that they were involved here if they own the Russell, and the way that the Russell 2000 index is now historically at its widest margin over Russell growth because of some of the drivers here. But when you think about the macro kind of fears, last time we saw the meme stock trade really take off, the market pulled back, and I wondered how much that might have been a direct link. So, I mean, if you're seeing this play out again, are there reasons to suspect maybe that we could see another triggered bout of volatility market-wide if people are to maybe be focusing in on some of these moves now?
I don't think so, because I think what we saw in January, February was more systemic. There were real elements of risk to the to the clearing system, as it were. And so that's behind us. I think the amount of leverage that's available to investors, is not the same as it was then. And I think that you've got better risk controls on the clearing side than you did at that point. So I think that from that sense, the volatility we saw was, I think, more systemic worry. That is just not here now. We've moved past that, and that's a really good thing. So I think it now has a greater capacity to exist in its own world than it did at the time, where there were effects that we were seeing outside of just the meme stock space.
Steve, it's good to get your insight today. Steve Sosnick, Interactive Brokers Chief Strategist.
All right, about 15 minutes to the closing bell. We want to keep an eye on what's happening with these markets. And you can see here that the Dow, the S&P 500, and the NASDAQ are in negative territory. The Dow now off about 12 points, the S&P 500 falling about 14 points, and the NASDAQ is off by 128 points. Sometimes investors pay very close attention to what we hear from the Federal Reserve, and the next FOMC meeting will begin on June 15th. Brian Cheung covers the Federal Reserve, and he joins us now because he has a special guest. Brian?
Thanks, Adam. Well, joining us here on a Yahoo Finance exclusive interview is New York Fed President John Williams. Thank you so much for joining us here on the platform this afternoon. Obviously, I want to kick things off with the economic data. A lot of eyes on the jobs report covering the month of May that'll be released tomorrow. The street's expecting 5.9% unemployment. Non-farm payroll estimates are bouncing somewhere in the 674,000 range. Now, I just want to ask you, what do you expect to see, or maybe rather, what would you like to see in that jobs print tomorrow morning?
Well, Brian, it's great to be here with you today. First of all, what I would like to see is, strong job growth. I'm very focused on achieving maximum employment. It's going to take more than 1 month to get there, of course, but I definitely would like to see a strong labor report in terms of job growth, continued progress on the economic recovery, and trying to get the country's economy back to full strength.
Now, we were speaking with Rich Clarida, the vice chairman of the Fed last week, and he was saying that at the pace of job gains right now, obviously given the kind of less than stellar report that we got for the month of April, it might not be until August of 2022 until we recoup the 8 million or so jobs that were lost compared to pre-pandemic levels. From your view, what you're seeing in the New York area or in the country at large, why is that pace not faster? Are there certain things that are holding back people going back to their jobs?
Well, this is an extraordinary situation we're in. The economy is reopening, supported by strong fiscal support and progress on vaccinations. I don't think this is a typical recession or a typical recovery. So it's really hard to predict exactly the speed at which this happens. Clearly, the recent data show demand is strong, and the supply side of the economy needs to catch up and grow at the same speed. So I think we'll have to see how that plays out over the coming months. But my view is overall we've got very strong demand going forward for the rest of the year into next year. I expect the economy will adapt to the rapid recovery, and we're going to see very good jobs growth. I expect to see really strong GDP growth this year. and see good growth next year. So I think it's, the overall picture is very positive. I think the timing of all this and how quickly, people can be matched with the jobs and businesses can reopen and all that can happen. We'll have to wait and see on that, but I'm pretty optimistic that that's going to happen. It just may take some time to get all that to come together.
Now, I want to expand on the sometime bit as it relates to quantitative easing in a second, but I do want to just kind of stay on this labor market theme because you walk down Broadway here in New York. I'm in Brooklyn. There's a lot of kind of postings that you see on these businesses saying we're looking for workers, we can't find workers, and obviously that is what we're hearing anecdotally across the country. But there's many kind of reasons for why people aren't going back to work, whether or not it's childcare or unemployment insurance. In your vantage point, what is the main kind of structural reason for why employers simply can't fill these jobs?
Well, I wouldn't call it structural reasons. I think these are really just adjustments of the economy opening up really quickly because of the progress on vaccinations, obviously supported by fiscal policy, that people are able to come back into the economy and spend money, and that's really great. It's just going to take some time, as it always does, for the businesses and others to adjust to that. Put out the vacancies. We know that job vacancies are really high levels. It takes some time to interview people, get people on board. And as you pointed out, there are still people clearly worried about the health aspects of the pandemic. We're not completely through that, and the other issues that you mentioned. I do think, again, this is a process that's going to take several months, to work itself out. But the strong labor demand, people, want to get back to work, and they will. It's just, it's just going to, I think, again, take a matter of a month or several months to see that progress. I do believe that businesses and the American economy is remarkably dynamic. Businesses will figure out ways to move that process along quicker, get people onboarded more quickly. Obviously, I think wages will adjust with a strong economic rebound, and we're also seeing huge numbers of new small businesses being created in the spirit of entrepreneurship out there. So all these dynamic factors, they don't happen overnight, but they are in play, and I think will help accelerate the economy getting back to full strength.
All right, President Williams, you did use the word progress, and we know that the guiding light for the Federal Reserve with regards to quantitative easing is that it'll start to taper that $120 billion a month pace of asset purchases once it sees substantial further progress. Now, some of your colleagues in Philadelphia, in Dallas, among others, have already said now might be the time to start thinking about tapering those asset purchases. Do you think it's time to start thinking about tapering those purchases?
Well, we set that, marker of substantial further progress, back at the end of last year. And, obviously the economy has improved. I think it's on a good trajectory, but to my mind, we're still quite a ways off from reaching the substantial further progress that, we're really looking for in terms of adjustments to our purchases of our asset purchase program. That said, we have to be thinking ahead, planning ahead. And so I do think it makes sense for us to be thinking through the various options that we may have in the future, talking about how the economy is doing, where we see it going, and understanding how that's, may play out over coming months, and really be thinking about those going forward. Right now, my view is, we're not near the substantial further progress marker, but of course we always need to be analyzing where we are in the economy, where is that relative to our maximum employment and price stability goals, and really how do we get monetary policy positioned well to achieve those goals, over coming years.
Okay, so you're not going to bring up that conversation in 2 weeks?
Bring up the
tapering conversation.
No, I think that we should be thinking through all of the issues around the economic recovery, and thinking about policy options in the future. I just don't think the time is now to take any actions on it.
Well, and some of that, I guess, might just be your approach or your views on inflation. There's a very rigorous debate right now about whether or not the current policy setting is going to allow inflation to maybe run away if the economy overheats. Now, just broadly, we did get a PCE print last week, core PCE, when you strip out those more volatile components, at about 3.1% year over year. We've heard your talking points about inflation being transitory, but what might you be looking for to see if some of those trends might be a little bit more secular and maybe less transitory or temporary?
Well, as you know, price stability, low and stable inflation, averaging 2% is one of our two key goals, along with maximum employment. So I take this very seriously in watching the data carefully, analyzing what's happening. This is again an extraordinary period of time as the economy opens up rapidly, and we're seeing demand, especially for certain things. People are willing to travel again and stay at hotels and get on planes and buy used cars, apparently, because that market is very hot. So we're definitely seeing that dynamic play out, and certain prices rise pretty quickly, while other parts of the economy we haven't seen those kind of increases. We also have to keep in mind that some of the increases we're seeing are really just reversals of price declines that happened a little over a year ago when the pandemic really took hold. So it's really about, I think, analyzing the data carefully, understanding what represents maybe the unique aspects of the reopening of the economy and not expected to persist into next year and the year after that, and what aspects indicate maybe more kind of persistent or sustained inflationary dynamics. So it's really about carefully reading the data, analyzing it, and I would just say not overreacting to every single data point, but making sure you're bringing all the information together. My personal view is that a big chunk of the increase in the inflation measures that we've seen is really partly this reversal of price declines from before, what we often call base effects, plus some special factors like used cars and others, where clearly the pandemic has affected demand for certain goods that are in short supply, at least in the near term. I go back to this dynamic economy, though. I mean, this is an economy that has worked on very, limited inventories and very tight supply chains in the past. And with the pandemic, that's made it a little bit hard to adjust to the rapid reopening. So, of course, we're seeing some supply chain issues, some shortages of supplies and things. But again, I see those as being worked out over coming months and quarters as businesses adjust to the more rapidly growing economy. Last thing I'll say on inflation is, even before the pandemic and, for many years, I do follow other inflation measures like the trim mean inflation rate. They're, produced by my colleagues in Dallas and Cleveland. And so, those measures are designed to try to get the underlying inflation rate, at least so far. I think that they've been showing moderate increases in prices, more consistent or near our 2% goal. So again, looking at all the information and really be attuned to looking for signs that we're seeing a more persistent, sustained inflation, which of course we would, we don't want inflation to be too much above our 2% goal. We really want to have this average 2% over time.
Welcome back to Yahoo Finance. I'm Brian Cheung alongside New York Fed President John Williams. We're talking a bit about where the economy is right now, but the New York Fed also has interesting purview with regards to financial markets. It does a lot of the legwork in getting its quantitative easing asset purchases done. So I want to ask about some pressures that have been happening in the repo market, namely reverse repo. A lot of these money market funds have been bursting at the seams with cash because of the quantitative easing, in addition to just the flow of U.S. Treasuries through the system. We've seen record subscriptions to the Fed's reverse repo facility as of the last week. I believe last Thursday was the record. Just wondering if you could offer a little bit of color on that. It seems like it's abnormal. Is there too much money floating around in money markets from the Fed's view?
No, the system was working exactly as designed. When we thought about it, set this up a long time ago, we wanted to make sure in a situation where we're making asset purchases, for our monetary policy goals, that, the matching increase in liabilities would be distributed in the financial system efficiently and well. And a lot of it shows up in the banking system as reserves, but also some of it can show up through the overnight reverse repo facility. And we have seen that get used quite a bit recently. We expected that to happen. It's working exactly as designed. Really no concerns about that. It's a system that was put in place so that we didn't have problems and we're not having them. So it's to me, it's working really well. And the fact that funds are flowing between the banking system and the overnight reverse repo, this is kind of what we would expect to happen in this kind of circumstance.
Might we expect to see some changes to the cap to the overnight reverse repo, or maybe even the payment or the interest that's paid on IOER to make sure that things are continuing to work properly from that view?
Well, sure. And we've made clear that in the past, and we actually, going back to earlier days, we've made adjustments, technical adjustments to these administered rates and these programs specifically to make sure they're working well. And for me, achieving the FOMC's goal of having the federal funds rate trading well within the target range. So we have the ability to adjust parameters of our administered rates or other parts of our program so that they work really well and keep interest rates where we want. So we can do that if that's called for. We've done it before and we made those adjustments, and I think they've been successful. So we have, not only is the program working exactly as designed, but we have the ability to tweak it, if you will, to make sure it's achieving exactly what the FOMC is looking for in terms of short-term interest rates.
All right, well, we'll keep it inside baseball. We'll shift to a different topic when it comes to corporate bonds. So the announcement from the Fed yesterday that it's going to begin unwinding the $14 billion or so in corporate bonds and corporate bond ETFs that it had purchased to backstop the corporate bond market last year. It was the first time that the Fed did that, which means it's also going to be the first time the Fed's going to try and unwind that portfolio, which the New York Fed is going to be working on, as I understand it. As a reserve bank that's carrying this out, can you pull that off without making waves in the market? And how do you think about this within the grand scheme of the Fed trying to get out of some of the programs that it had last year?
Right. And, as you know, we put those programs in, not just this one, but the others in the midst of, extreme market distress and turmoil back in March and April in that period last year. And I would say that they, across the board worked really well, both at making sure that markets were functioning well, and more importantly, that credit continued to flow to businesses, to households, to state and local governments. So those were put in a moment of emergency when markets were under a lot of distress. They came in and did exactly what we were looking for to make sure that the credit is flowing. As you know, credit's the lifeblood of the economy. And so they were successful. At the end of last year, most of those programs were shut down in terms of taking new business. And so, of course, one of the, and some of those just end because they're doing shorter term lending. But for the corporate credit facility, we did buy corporate bonds, either through ETFs or individual bonds. And given the strength of the economic recovery, the very good conditions in the corporate bond market, which is a very positive development for the economy, it's an appropriate time to gradually and carefully, unwind those positions that we accumulated last year. So, of course, we're going to do this, carefully and making sure there's orderly market functioning. The markets are working really well right now, so I think it is appropriate. It's a relatively small portfolio relative to the enormous corporate bond market. So I think this is a good sign that the financial markets are working well. Some of these emergency things that I think were hugely successful and did exactly what we wanted them to do, we don't need those anymore, and we can close those down and move on.
Now, if we zoom out a little bit, maybe this is something that the Fed would prefer, but it seems like maybe the Fed is not the top headline right now when it comes to finance news. People are reading things about Dogecoin or AMC stock. Just broadly speaking, when it comes to just the rise of retail investing, does any of that pose any sort of financial instability concern from your vantage point?
Well, this is something we take very seriously, not only the Fed, but the other regulatory agencies and the U.S. government. So something to make sure that our financial system is both stable and serving the economy. Now, clearly, there are questions that people are looking at in terms of, investor protection and, things like that are, really in terms of other regulatory agencies. But from my perspective, these issues, don't really pose a financial stability concern. Where I look for financial stability concerns is really where, you think about where there may be excessive risk taking or leverage in the financial system that could pose a broader concerns to the availability and the flow of credit. But obviously, these are important issues, but I don't think these are ones that are particularly about financial stability.
Copy that. And sorry, there's a siren going by. You live in New York, so you understand how this goes. But I do want to ask now about R-Star, if I could do that. So there's been a lot of interesting commentary going on right now about how the Fed estimates what is the neutral rate of interest, kind of the rate that's neither stimulative nor restrictive for the economy. But there's been some commentary from the likes of Christoforous at MIT, Jan Hatzius at Goldman Sachs about maybe missing the estimates with some of these structural things in play, like companies that might be getting more productive with the COVID shock or demographic trends. So I guess my question to you is, estimates of R-star are very low right now. That's what's guiding your policy. How is the power of R-star kind of changing with what could be structural changes to the economy?
Yeah, that, obviously it's a question I think about a lot. I think a couple of things I would say is this COVID situation, at least in terms of thinking about those trends and the effects on the neutral interest rate, it's just really challenging. We have huge shifts in demand and supply and all these things happening at once. So I think it's time to be appropriately humble about our ability to draw inference about how does this affect the neutral rate for the next 10 years, because I think we're still in the middle of the COVID episode in terms of seeing how the economy behaves. So I'm kind of on a wait and see on some of that. Again, I do go back to what do I think were the underlying trends that were driving the neutral interest rate lower for the past 25 years before COVID. It was demographics. It was low productivity growth. And I think it is a demand globally for safe assets like U.S. Treasuries. So those may have shifted a little bit, and we'll wait and see whether productivity trends have improved as we've all learned to work with technology differently. We'll see if demographic trends have changed, but I think those were the big drivers. So those are the things I would be looking at to see if there's really a change in the neutral rate. My view right now, again, kind of recognizing there's just a lot of uncertainty, is that neutral rates are still very low across the globe. That's my working assumption, but I do think there's just a lot of uncertainty about that. And we have to have an open mind about how that may have changed coming out of COVID. The last thing I just have to say on this is it's a global phenomenon. And for a lot of other countries, I think a lot of these factors are still holding the neutral rate down. They haven't really changed.
I mean, what might be the consequence, though, if the actual R-star is above what you're estimating?
Well, I think, it would be a sign mostly of a stronger fundamentals for the economy, stronger productivity growth, stronger labor force growth, some of those factors. So those are all positive. So I'd rather have, if I think about monetary policy, I'd rather have a stronger kind of baseline growth in labor market as is what I'm aiming for in terms of what maximum employment means. So I think those would be very positive. And they would imply that in the long run, you'd have on average somewhat higher interest rates, which would be consistent with a strong economy, but also clearly give us a little bit more room to adjust monetary policy when the economy is in a downturn or inflation is too low. So those are all positive. So if you did ask me, what's a good thing for the long term for the economy, would be fundamental factors that help push up our source. So I'm hoping for that, but we'll have to wait and see if the data really does support that those changes or have happened.
All right. Well, no one better to have that R-star discussion with than you. But again, thank you so much for joining us here on Yahoo Finance. New York Fed President John Williams. Hope to talk to you again soon.
Very well.
The investing and savings app Acorns is going public via a SPAC with the blank check company Pioneer merger in a deal worth $2.2 billion. And Acorns investor base reads like a regular who's who: Jennifer Lopez, Alex Rodriguez, Ashton Kutcher, Bono, even Kevin Durant. Joining us now is Acorns CEO Noah Kerner. Noah, good to see you again. I remember 5 or 6 years ago, you coming on Yahoo Finance and giving us one of your first interviews when the company launched. Now you're about to go public via a SPAC. Why go public now, and why do it this way versus a traditional IPO or a direct listing?
It's a great question, and it's great to be here. Also, remember BlackRock, PayPal, NBC, Comcast, DST, Bain Capital, and a bunch of other investors in the company.
The list goes on and on.
Yeah, the list goes on and on. TPG. The reason for doing this now is all about the customer we serve, which is the everyday customer. The $50,000 to $75,000 income customer who we serve. And it was before COVID and during COVID that what's sort of happening in the market is not sustainable. And so we felt that we need to accelerate the process of getting this product into as many people's hands as fast as possible and put the responsible tools of wealth making into everyone's hands. So it's really an acceleration of that and getting this into as many people's hands as possible and getting everyday American set up for a better future.
So to that end, Noah, I mean, Acorns is a fair bit smaller than your competition, like Robinhood, for example. I'm curious to know what changes might be forthcoming in the future to really allow you to compete with a Robinhood, for example.
Well, I would say when you understand Acorns, this is a long-term saving and investing product. We have over 4 million paying subscribers, really sticky paying subscribers. And it's a very different product, right? And it's serving the customer to help them achieve financial wellness over the long term, to make sure they're saving and investing over time, benefiting from compounding and building that sticky relationship with these customers. So we want to get as many customers on the platform as possible. We're planning to get to 10 million paying subs by 2025. And we have all kinds of plans to get there. We just started rolling out our ESG portfolios to introduce customers to the ability to not just save for them and invest for themselves, but also for the planet. Obviously, you know, we focus on diversification, and we're introducing all kinds of features to help spur compounding, to help get people diversified, to make sure they're educated as much as possible, and make sure that they're taking care of themselves and their families for the long term.
Is part of that diversification, Noah, getting into the crypto space, allowing investors to play in that area? And also, what are you doing in terms of some of these meme stocks? Are you offering those to your investors? Because for those who aren't familiar with your model, there's really no self-directing of the funds, right? You're sort of making those decisions for people.
Yeah, I mean, when you look at history, diversification is what works, right? So we want to make sure our customers are diversified. We want to make sure they're investing the right way, that they're benefiting from compounding, and that we're setting them up for a better future that way. And it's just the right way to invest for the long term. And that's what we focus on, and that's what we help everyday consumers focus on.
Is part of that offering things like cryptocurrencies, if not now, then in the near future?
Well, I would say if you thought about how self-direction might happen on the Acorns platform, it would be as part of a slice of your portfolio, much the way I or you would be advised to invest, right? You wouldn't want to do it with more than 10%. So that's the way to think about it in the world of Acorns. Again, diversification, long-term thinking, compounding, education, that's what's really fundamental to Acorns and the platform and how we're trying to serve the everyday consumer.
I want to follow up here, Noah, because Alexis did also mention some of those meme stocks. Curious to know if some of the funds that are being invested from some of your customers are also being directed into some of those stocks, which a lot of folks say are frankly speculative and just out and out gambling. So are clients' money being directed perhaps to some of those meme stocks, as we've been calling them?
These are BlackRock and Vanguard ETFs, right? So they're diversified investment portfolios. And so it's about owning thousands of stocks and bonds. We set the customer up based on their risk profile into the right portfolio. So it might be conservative, it might be moderately conservative, it might be aggressive if you're younger, et cetera. But it really is about diversification, and I can't stress that enough.
And you do stress getting folks when they're young to understand and invest and save is so important. But how young is too young? Because you see companies like Fidelity, a traditional investment firm, now targeting people as young as 13 to start saving and investing. What's your feeling on that?
Well, we launched Acorns early to get parents investing in their kids as early as birth. So I think there's never a time that's too early. I mean, imagine if every parent in America started investing in their kids at birth. That would be wonderful. But diversified investing. So that's what we offer. Their portfolios, Acorns Early is diversified portfolio where parents can start saving and investing in their kids as early as birth, 1, 2, 3, 4, 5. We have family financial literacy. You can invite the whole family in to participate through a gifting feature. But it's never too early, assuming it's based on best money management principles and enabling the power of compounding.
And finally, do you see a path to profitability for the company? And are you able to offer a timeline for potential investors?
Yeah, absolutely. I mean, we could be profitable today. We're leaning into growth. We have a fast growing subscriber base. They're really sticky, strong gross margins. Our NPS is really high. So our plan is to glide path into profitability in 2023. But again, we could be profitable now. It's just time to lean into growth and acquire customers, keep them sticky, and build the platform so that we're looking after everyday consumers across America, ultimately globally.
Real quick before you go, when do you expect the deal with the SPAC to close and investors will have the opportunity to buy Acorns?
Later this year. And we're planning to have the ticker symbol OAKS from Acorns Mighty Oaks Grow.
I like it. Sticking with the tree theme. All right. Noah Kerner, a CEO of Acorns. Thanks so much and best of luck.